Silver investors, markets are closed, you've got 48 hours, and what happens when silver opens on Monday could define whether we just printed the bottom of the most violent correction in 6 years, or whether there's one more leg down coming that almost nobody has emotionally priced in. We just lived through a 10% crash, a 5.5% rebound, a 20% two-day range, and a brutal flush in speculative positioning. And now everything comes down to 3 price levels, $75, $78, and $80. I'm OG John AG, and in this video, I'm going to walk you through exactly what happened this week, the 3 levels that will decide Monday's script, why the latest positioning and delivery data should terrify the shorts and excite anyone who understands the physical market, and how I'm reading the next few days as we head into a March delivery month with a 4-1 paper-to-metal setup. Segment 1, the crime scene week, 10% down, 5.5% up. Let's rewind the tape. Thursday, 12th of February. Asian session opens heavy, silver already under pressure. Europe steps in and accelerates the selling. Then U.S. employment data hits, 130,000 jobs added versus 70,000 expected. A modest beat, not a shock. Silver doesn't just drift lower, it crashes 10% in one session, from $86 to $76. Context: this was the 3rd worst single-day decline in silver since COVID. Only 2 days were worse. The 36% crash in January, the worst day in silver's history, the initial COVID panic in March 2020. But Thursday was different. No surprise Fed meeting, no war headline, no systemic credit event. It was a margin hike-induced forced liquidation event. Key moves behind the scenes: CME raised silver margin requirements from 15% to 18%. Oanda Japan cut trading limits by 70%. Translation: the system tightened the screws on leveraged longs right before a major macro print, Friday 8:30 a.m. Eastern. January CPI drops. Headline inflation, 2.4% versus 2.5% expected, 2.7% prior, lowest since May 2025. Core CPI, 2.5%, lowest since early 2021. Market prices in more rate cut risk, dollar weakens. Silver rockets 5.5% off Thursday's low to close around 78. So in 48 hours you had a $10 crash, a $5 recovery, a $15 20% range in 2 days. That's not a normal week. That's a battlefield. Segment 2, 3 levels that decide Monday, 75, 78, 80. Now with markets closed, everything narrows down to 3 numbers. Level 1, $75. Breakdown line 75 is your first line in the sand. If silver breaks below 75 on Monday and actually closes below it, not just a wick, that opens the door to 70. Why 70? That's the first big support from the early February sell-off. Below 70, the next major reference, the 200-day moving average around 55. The host is clear. He doesn't think 55 is realistic given fundamentals and physical tightness, but the chart says it exists. What to watch at 75? If price is sitting near 75 in the first 30 minutes, watch volume. Heavy volume break, real breakdown, algorithms pile on, flush to 70 is on the table. Light volume dip, likely fake out, higher probability of a bounce. Level 2, $78, consolidation box, 78 is where Friday closed. It's also right in the middle of the current battle zone, 76-77. Support from Friday's bounce. 80, the 50-day EMA, major resistance. If Monday opens and price chops between 76 and 80 all day, that's actually bullish. It says Friday's buyers are still holding. It says Thursday's forced selling has exhausted itself. It's the start of a base. Best case Monday for bulls? Boring. Stuck around 78 with a tight range and declining volume. Something like 77, 79. That's a coiling spring. Boredom after violence is how big next legs are built. Level 3, $80. Breakout trigger. The 50-day EMA is sitting at 80. Technically and psychologically, it's a fortress. If silver opens near 78 and punches through 80 with strong volume in the first hour, Thursday's crash becomes a stop hunt, a final shakeout before higher. Above 80, next resistances, 83, then 86, 88, pre-crash zone, then 90 plus. Above 90, this whole week's chaos becomes noise inside a larger bull. What to watch at 80? Fast push with heavy volume. Institutional buying, smart money saying, bottom is in. Slow grind to 80 over hours, more like short covering, still positive, but less explosive. Segment 3, positioning. Weak hands flushed, field reset, technical levels matter, but who holds what matters even more? The latest COT data, as of 3rd in February before this week's chaos, shows net speculative long positions in silver were slashed 38%. Net spec longs fell to their lowest level in 23 months. Managed money funds, the big hedge fund and CTA crowd, held just 4,900 contracts net long. They were almost net short. Gold, net speculative longs cut 23%, the lowest since October. Open interest collapsed by almost 79,000 contracts in a week. So what does that mean? The tourists are gone. The everyone and their mother is long setup from January has been dismantled. Leverage has been systematically destroyed. In positioning terms, the market has gone from crowded and euphoric to clean, with fewer weak hands left to panic sell, and bottoms often form not at the prettiest level on the chart, but when. Everyone who was going to puke has puked. The selling cohort has run out. That's exactly the footprint you see in this data. Segment 4, how Thursday was engineered, margins, algos, and CPI. Now the timing piece. Sequence. CME hikes margin from 15% to 18%. Oanda Japan slashes trading limits by 70%. Jobs data slightly beats. Silver drops 10% in one day. Then, 24 hours later, CPI comes in bullish for metals. Lower than expected, lowest headline since mid-2025, lowest core since early 2021. Silver rebounds 5.5%. Ask yourself, as the video does, if you're a major bank holding a big short and you know CPI is coming Friday, do you really want silver at 86 going into a likely bullish inflation print? No. You. Hike margins, force weak longs out, use algos and a small data beat as cover to trigger a cascade. Then when CPI hits, you cover at 76.78 instead of 86.90. The tape shows exactly that. Violent force selling Thursday, aggressive buying Friday at lower prices. And Friday's rebound tells you something critical. Physical buyers were waiting for this. They wanted lower prices. When they got them, they showed up. Segment 5, March Comics. 400 Oz claims versus 100 Oz registered. Now the bigger bomb, March delivery. March silver futures are about 2 weeks from a major delivery month. Open interest represents over 400 million ounces of theoretical delivery obligations. COMEX registered category. Silver actually available for delivery, about 100 million ounces. That's down 70% from 2021 highs. So you've got a 4.1 ratio, 4 ounces of paper claim for every ounce in the registered bucket. Zoom out further. Total open interest across all silver contracts versus total COMEX inventories is about 500.1. Now, reality check. Most futures contracts don't stand for delivery. They roll or cash settle. That's how the game has always worked. But here's what's different now. Silver is in backwardation. Spot price higher than futures. That does not happen in markets drowning in surplus. It's a shortage signal. Delivery data, February, about 2,700 contracts delivered, 13.8 million ounces off COMEX. In January, there were days where 1,624 contracts delivered, while open interest increased by 1,431 contracts, new buyers coming in specifically to take metal. Globally, Shanghai warehouse stocks at 15-year lows, London deliverable silver at record lows. China's January 1st export controls now require state licensing, effectively trapping 60-70% of refined supply inside China. Dealers reporting sold-out conditions, Silver Eagle premiums 27%, 120% over spot. So paper market just had its biggest washout in years. Physical market is screaming shortage. March delivery notices start in 2 weeks. Monday's tone will influence. How many longs stand and fight in March? How many roll or cash settle out of fear? Segment 6, Monday game plan, how to read the open. The video lays out a clear plan you can apply whether you trade, stack, or just track. First 15 minutes, 9:30, 9:45 a.m. ET. Watch where we open versus Friday's 78 close. Gap above 79. Bullish overnight positioning. Asia, Europe buying. Gap below 77. Selling pressure continues. Thursday wasn't fully finished. Open flat near 78. Likely grind. Market wants more info before choosing direction. First hour, 9:30, 10:30 a.m. ET. This is where real money shows up. Do we hold the opening level or reverse hard? Big volume with a push toward 80. Institutions stepping in. Low volume chop. Market still digesting. Waiting on Fed minutes. Macro data. The 80 test. Anytime Monday we get near 80. Rejection at 80 with a red candle. Likely drift back toward 75. Break and hold above 80. Fast run to 83 and possibly 86, 88. Gold correlation, gold closed Friday around 5,030. If gold pushes toward 5,100 and silver lags badly, warning sign. If both move together, healthy. If silver outperforms gold, that's when you know the real move might be starting. Segment 7, big picture. Violent but normal for silver zoom out. Silver has almost tripled from the lows, 28.95 in January. Now it's back to 78. About a 40% correction off the high. Is that huge? Yes. Is it abnormal for silver? No. History, 2010, 2011. Silver from 18 to 49, 30% correction during the bull. 1979, 1980. Multiple 25-35% drawdowns on the way to 50. Silver is arguably the most volatile major asset on the planet. If you can't stomach 30-40% drawdowns, you shouldn't be in silver. But look at what hasn't changed. Central banks still on pace to buy 850 plus tons of gold this year. Dollar still down shivered 9% year on year with more cuts priced in. Silver in its sixth straight year of supply deficit. COMEX vault still draining. China still restricting exports. Physical premiums still elevated. The bull case hasn't changed. Only the price and the ownership have changed. Segment 8, what I think happens next. The host's base case and mine for framing. Based on the data, Monday opens between 76 and 80. First hour is choppy as everyone recalibrates. By Tuesday, Wednesday, we get FOMC minutes. Two macro scenarios, dovish, Joch, worried Fed. Minutes show concerns about growth. GDP data is weak. Market leans into cuts. Silver likely punches through 80, accelerates toward 85-90 within a week or two. Hawkish, strong data Fed, still very concerned about inflation. Economy looks firmer than expected. We might retest 75, maybe 70 before the real bottom is cemented. Either way, March delivery is the wild card. If you're short and you see delivery notices piling up, vaults at multi-year lows, China locking exports, market still in backwardation, how confident are you that you can cover at these prices? That's the question banks are asking this weekend. Monday's reaction at 75, 78, and 80 is the first clue to their answer. You've been watching John AG here, and I'm OG John AG. If this helped you see why Monday's open isn't just another candle, but the first page of the next chapter in this silver bull, hit like so this kind of level-by-level breakdown doesn't get buried. Subscribe and turn on all notifications, because whether we bounce from 78 or flush to 71st, the real story is the cleaned out positioning, the physical shortage, and a March delivery setup that could make the next move far bigger than the last 2 days' chaos.